We have reviewed the performance of Asia-Pacific office markets over the first half of 2020 and adjusted our forecasts for the next 5 years. We highlight 5 conclusions. Demand is under pressure, but should pick up gradually. Aggregate absorption over 19 Asia-Pacific office markets fell 56% Q-on-Q in the second quarter, and despite signs of a pickup in China, should fall 41% over this year. Average annual absorption over 5 years should be close to last year's level. We see heavy supply over 2020 and 2021. Led by China and India, aggregate Asia-Pacific supply of office space should be 2.8 times absorption this year. Supply should remain high in 2021 but ease thereafter, with demand and supply balanced by 2023. Rents are declining now, but the medium-term outlook is brighter. Weighted average Asia-Pacific rent should fall 5% in 2020, while over 5 years we see an average annual rent decline of 0.7%. Popular occupier centres such as Singapore, Bangalore and Melbourne CBD should achieve higher rent growth of between 3.3% and 2.5% on average over 5 years. Vacancy is set to rise for 2 years. The aggregate Asia-Pacific vacancy rate stood at 11.4% at the end of Q2. We expect aggregate vacancy to peak at 14.5% at the end of 2022 and to ease to 13.3% by the end of 2024. Capital values are not collapsing. Despite a 48% year-on-year drop in aggregate office investment sales in Q2, capital values have yet to fall sharply and yields are little changed. We expect modest yield softening over the second half and the first half of next year. Based on these conclusions, we have 2 key recommendations. Occupiers should act now to secure good deals. With conditions in many markets set to favour tenants for up to 3 years, tenants have the chance to lock in good deals in districts like Hong Kong Central, Shanghai's New Bund and Shenzhen's Qianhai area. And investors should focus on popular occupier centres. Popular office markets with solid rent growth, like Singapore, Bangalore, Melbourne CBD and Auckland, have the greatest potential for long-run capital appreciation. Singapore offers the highest average annual rent growth in Asia-Pacific over 5 years at 3.3%, while Auckland offers the highest spread over 10-year government bonds at 5.1 percentage points.